Must be a few questions.
If you get a tie question, you do a pass.
I will if it's too local. Yes, hello.
Why do you like investing in Japan if Japan is the biggest disaster economy in the world?
Yeah, I think it's been pretty much priced for that for a long time, and which is what's caught a lot of people out. Yeah, I think the market rise we've seen in Japan over the last 6 months is probably a number of things. It's partly because of what Abe is trying to do and move it out of deflation, which I think principally is what he's trying to do. Not so much currency manipulation, but to move the economy out of deflation is the important thing, which is quite hard to do as the rest of the world is sinking down into disinflation and potentially deflation if we're not careful. And to try and do that, they couldn't get rid of deflation when the rest of the world was booming, so it's going to be quite a hard job maybe doing it now. But there are a number of factors. I think a slightly weaker yen, the way asset prices have rebounded is already strengthening the economy. We've seen property prices at last, over the last sort of 12, 18 months, start to rebound from very low lows. We're not talking about a UK or a US crash here. Things have fallen 60 to 80% commercially and residentially. So, I think from a very low base there was always going to be at some point some correction. What happens next will be a lot to do with Abe. But we know how the world works, and it's not always about when things overreact. They tend to overreact even more and then even more again. Like a lot of people, Japan's been left off asset allocation charts for quite a long time. When I talk to people, and have been over the last couple of years, saying Japanese equities have been our largest risk weighting in the portfolio, people shake their heads and are not sure whether I should be speaking or not, but that's a view we've taken. And those people are looking rather nervously at their portfolios at the moment, where it's been the best performing market this year, both in equities and property, and yet they've got none in their portfolios. And I'm not just talking locally here, I'm talking right the way around the world. I'm not quite so sure what it's like in the US, but I'm sure it's similar. It's certainly very true in Europe. Very large institutions have got zero equity weightings in Japan, and they'll need to get something on their asset allocation charts, I suspect, during the year. So I think there'll be buyers back into the dips unless it completely unfolds. But there's lots of other fundamental reasons as well, but that could perhaps take a while.
Mark, are you shorting the Australian dollar, or would you if you could?
Well, two things on that. Let's start by saying the fund is a daily priced, regulated fund. It has no enhanced powers, which means it cannot use derivatives or futures. However, we have an ETF for a small part of the portfolio, a couple of percent, which is short Australian dollar, long US dollar. Now that would sound very clever over the last few weeks, but it's been in there for over a year. Now we did buy at around about 106, 108, but the reality is that the interest rate differential has taken an awful lot of our gain away. So yeah, it's positive, but it hasn't been great. But that was more of a play in the short term on our weighting in Asia. So it's a little bit of protection, if you like, there, rather than a very hard currency play. Because we have to use ETFs for that sort of thing, it's never going to be a big part of the portfolio. In a similar way, I do have a holding in the portfolio which is euro denominated. The fact that it's short European banks means it's a defensive positioning, but to take the euros out, I've also got an ETF that is short euros, long US dollars. So we use it for those sorts of things, but it'll never be a big part of the portfolio. Having said that, the Aussie dollar is still hugely overvalued. I do agree with Paul, but these things take a long time and can burn a hole in your pocket while they're getting there. Sorry, there was that you were going to ask in front.
In the US, have you made any observations around share buybacks and how they're driving stock prices up?
Yeah, well, an interesting point. Because earnings growth in the US has managed to maintain positive. I was a bit surprised year on year it did come out as well as 4.5% or whatever it was. But yes, you can't say across the board, but you're absolutely, I know what you're referring. Companies are not investing for growth. They're raising capital mainly through the bond markets, gearing up their balance sheets and just using that for share buybacks, which is great for earnings per share, great for board bonuses, you know, for hitting targets. And it's a bit cynical, but I'm afraid it is true. Until we see those same corporates raising money to invest in their businesses, which is not happening, not at the large cap end, and at the small cap end, they still can't get their hands on much money because it's not easily available. So, and even if you've got, we're moving to that Japanese scenario. Even if you've got quite a nice little successful business, few of us are running a nice business here in the US, and we think it's great. It'll fit in other places, but do we want to take risk and gear up to actually do that, or is it just happy to carry on as we're going, making nice profits, paying the mortgage and the school fees, and actually be quite happy to continue as we are and just wait and see what happens next? Yeah, just generally. Well, from a commodity point of view, I've got no commodities in the portfolio. I did say resources, and that's a couple of oil stocks actually. That's BP that I bought quite a long time ago at quite low levels after the disaster, which I haven't actually got rid of all of yet, and another exploration business. But commodities in general, they've run with every risk-on rally till the last 6 months, and they just haven't run with this one post the presidential election in the US 6 months ago or so. And why is that? Well, I think there's a couple of factors. I think one, people are still looking for yield, not just speculation, and yield drives people away from commodities to some extent. But also commodities, most commodities are priced pretty tightly at the margin. You've got 1 or 2% too little of something to go around the world, and you're going to get a huge spike up in prices. And the same way, if you've got 1 or 2% too much, you eventually going to get a big spike down in prices. And I think it's just that, you know, the prices have held up better than I thought they would. But you know, China's demand for most commodities is weakening, and you know, with things like corn and wheat, you tend to have, and soybeans, if you get a weak harvest, then it's an automatic thing that people plough a few more fields or transfer crops that weren't so successful last year into the same thing. And it appears this year we're going for a glut. You know, the corn price has just been trashed over the last number of months, as a for instance. But you know, if you look at base metals, and actually, again, it doesn't make it sound we hold lots of shorts, but one of our plays against China is we've had a small holding, which is a short ETF on base metals, because I think Chinese demand for metals will continue to weaken. Warehouses, LME warehouse and other warehouses around the world are full, or fairly full, of most metals. Grain houses are beginning to get stocked up again. Countries have learnt their lesson back in the food uprisings of 2008 and want to make sure that they've got plenty of everything they need to. I gather oil at the moment, there's probably a lot to do with your shipping chart, Paul, is very slow floating ships around the world with crude oil waiting for somebody to want it. And of course, it's all the discovery of fracking and shale oil. These things are great, but they've got to get into the right places, and that's we're a long way off managing to ship that stuff easily around the world at low cost anyway. So I think prices can continue to ease. So I'll come back to you in a second. There's another one over there. So.
What do you think about US dollar? Usually when the QE starts to taper off, they are expected to happen right now. Dollar should start to strengthen. Dollar has been strengthening all along now with the stock markets in the US. Obviously, if you look at the Asian currencies, they should weaken, Australian dollars should weaken, Japanese yen is for sure weakening as long as they print money. But now every day you have a down day, like today you have a down day. Nikkei is down to about 300 points. Australian dollar rebounded very strong. Euro is rebounding. So that's kind of very, very contrary of what usually should happen, right? What do you think of US dollar long term?
Well, well, from the geographic allocation, you can probably understand that we've been accumulating steadily over the last couple of years dollar-denominated assets. It hasn't been a rush into dollar. It proved us totally wrong last year, and you know, we struggled because of it, because with the sterling core to the fund, although it's denominated in lots of different currencies, that damaged us. I couldn't believe that could be sustained forever, and at least we've seen a little strengthening of the dollar this year. Historically, if you go back to the last decade or so, the Americans have certainly been the best in the world at manipulating the dollar down, manipulating their currency down. They've been more successful than anybody else, and it's going to be hard for them to accuse the Japanese of rigging the yen when they've been so successful at doing it themselves. And I guess we're now reversing little. Well, as you're saying, if we're on. The risk-on, risk-off is reversed to some extent, because if the markets are bad, the economic news is poor, then the US will keep printing for longer. Therefore, that'll keep the dollar weaker. So if the news turns good now, we're going to see the dollar strengthening maybe, because the sooner the taps will start to get turned off. Although we're a long way away from normalisation of interest rates, I would suspect. But I think that's a little bit the way it's going at the moment, and certainly. Yeah, that's a factor we accept. You would still expect in a crisis, though, and this is just a bit of a sell-off we've had, or a bit of volatility, at the first proper volatility we've had in a long time, in a year actually. I would expect in any kind of proper sell-off, then I think naturally the dollar and the yen will weaken against will strengthen against most other currencies. But that's a very broad view. Within that, if you're trading, which we're not, there's going to be a lot of opportunities to make the right calls or not. Sorry, how's that?
Yeah, Martin, or you can Stephen, if you can look into your crystal ball, precious metals, particularly gold, with inflation picking up the way it is, you would think gold would be following, but yet we're seeing the reverse.
Yeah, well, I'd like to, well, not say I'd like to think. I mean, I was concerned about inflation, but where is inflation coming from? I mean, I think we should be more worried about continued disinflation, maybe deflation, because I think Europe's definitely heading that way. And if Europe starts to move into a deflationary environment, that's not going to be good for the rest of the world, because it will drag it down a little bit with it. I don't know, but my concerns are more towards deflation than inflation at the moment. But you're right, at some stage, if the world economy does start to pick up, then what happens to all this liquidity sloshing around? The banking system doesn't require it anymore. But I think that's quite a number of years away. I don't know how many years away, but it's quite a number of years away, I think. And I'm not quite sure how quickly that'll happen. I mean, gold's interesting, isn't it? Because
China's buying it, you know, using it, Iran's using it for currency and different things like this. So it's like.
yeah, but most people who wanted it have already got it in their portfolios and actually put it there back in the Greek crisis. So the big buyers are there. You know, it's all already happened. And then we've got a lot of froth at the top end, which is being blown off at the moment. You know, I'm not saying gold isn't to buy. If I was super wealthy, and I can assure you I'm never going to get there, you know, I would have physical gold somewhere at hand. Well, in the vegetable patch maybe, you know, along with the electric fence I've got stored by the side in the garden shed, just in case we have another crisis, because that's your Armageddon scenario. Have some gold and make sure you've got a rifle and some electric fence to protect your vegetable patch. But yeah, physical is always better. Look, for most of us, etc., that's very, very hard, whether it's physical paper or physical equity, you know, or equity. You know, we can't. It's not practical for most people, but paper isn't what you want to hold. Oh, sorry, there's a guy just behind you who's just been given the mic.
How do you explain that the stock market in the US is that high?
Because the central bank is just, you know, the Fed is delighted. It needs to keep some kind of you know, enthusiasm and an asset price movement going. It's not fundamentals. I think there's a sort of a media-led Bloomberg, CNBC belief that, you know, everything is a bit more rosy now out there. But, you know, behind all the stats, it's quite. You can make a bull case out of most things, but it's not that difficult to make a bear case. Paul will probably make a much better job than I would. But, you know, the employment stats, as I mentioned earlier, is a great place to start. You can make a bull case for employment numbers coming down and all those good things, but it's just as easy to make a bear case. If real earnings growth has gone nowhere in 18 years, that doesn't strike me as at the median level. Sure, that top 10% is having a bull. They're having a wonderful time. You've got loads of assets, they're all going up in value, you're making more money, you're having more fun, more time. But to the rest of the economy, it's going nowhere, and if anything, it's going downwards. And that's true of other mature economies around the world. Real earnings growth has been negative across Japan, Northern Europe, UK, US, at the median level, and in some cases just in general for the last decade, or gone nowhere anyway. So people aren't taking home any more money. So it isn't great, but we're getting away a little bit from your question. But you know, the US market is rising on PE expansion, which is fair enough. Maybe the growth will follow through. I'm sceptical, very sceptical. Yes, okay.
On the equity side, does your company take into account the ESG, the environmental, social, and governance factors?
Sorry, the
ESG, environmental, social, and governance factors of
social
investments?
governance.
And if so, is that based on your firm's philosophy or more demand from the clients investing in the fund?
No, well, I'm afraid, well, not afraid, but our policy is to make as much money as we possibly can with all the funds we run to the best of our ability, with the lowest volatility we can, and leave the investor to make the decisions on how they want to spend those profits or give that money. So there is no, as we call it, SRI, but social responsibility in that. We buy a lot of what we do is to get into a lot of parts of the world in different asset classes. We use other funds, so we do use a lot of fund of funds. So we have to, because there's no way on the global participation within the fund if we want smaller Chinese companies that we can go out and research those ourselves. Complete possibility. So we'll buy another fund, and we're not going to monitor what their holdings are. So I'm afraid those of you who need that kind of thing for your portfolio, we can't help you. Hopefully that's a straight answer, but I'm not going to pretend it's anything other than that. So the gentleman at the front here, you had a...
Question about quantitative easing. Dealing with the US Federal Reserve and the Bank of England, is it realistic, in your view, to expect at the end of quantitative easing for the Federal Reserve and or the Bank of England to actually sell back into the market the T-bills and the gilts they've actually purchased with printed money? I mean, at the moment we're talking about printing money as if we were printing money. In fact, what's happening is the central banks are building up a balance sheet composed of their own government's bonds. Yeah. But it would be open, if the banks are truly independent, it would be open to them to actually sell back those T-bills and gilts back into the market, in your view, causing a massive increase in interest rates. In your view, is that realistic?
I'd like to think central banks were independent, but I don't think there are any out there. They all seem to be politically influenced. There's a number of factors there. I don't think any central banker or politician knows the answer to that question, or has even got a plan A or a plan B for it. They're feeling their way. I don't think any of them ever imagined that 4 years down the line from when they started this exercise that they would still be doing it, and more frantically and to larger numbers. I don't think any of them have got a clue yet as to how that will turn out. As far as the politician's concerned, he's only worried about the next election, and very little more than that generally. And central bankers change every now and again. We might see some change in policy over the next year or so. I don't know. I don't think they know either. We've seen that with Japan, with the Bank of Japan. A change of central banker has meant a huge change in policy. And who selects the central bankers, by the way? It's the politicians. They're not independent in that respect, so they choose. We've got, in the UK, we've got Carney coming on board. Now that's an opportunity for him to change the policy a little bit, or fine-tune it a bit. There's a lot of talk that he'll try and weaken sterling, but we'll find out. In the US, Bernanke's reign comes to an end first quarter next year. There's no idea yet as to who it will be, but it's not going to be a Republican representative, I shouldn't think. Well, there'll be some argy-bargy in terms of how it does happen, so there may be some change there. No, I don't think there's any plan. Look, when QE started in second quarter of 2009, I couldn't get my brain around what the implications were going to be and what the outcome might be. And I'm sorry to say, 4 years on, I'm still of that same opinion. I don't know what the outcome will be and what effect that'll have on the global economy. It's difficult to imagine that so much money has been flooded around the world to try and keep the banking system alive, rather than writing down debt, just creating liquidity and creating more debt, that I don't know how this unwinds. It's certainly not going to unwind anytime quick. You're not going to see, are they just going to cancel that money or burn the gilts or the treasuries? I don't know. I haven't got a feel. I say there's lots of different arguments, but I don't think they know either at this stage. Could be.
While I'm here, if I can.
Martin, I think you've got time for just one more question.
Okay. Have we got a, sorry, somebody, one down there again, yeah.
You spoke about the global economy, the venture. Have you any opinion about the Thai baht? The relationship with the Thai baht?
I could probably leave it to Paul, but I mean, just in general, for the region, you know, a lot of hot money and higher interest rates, and this is not just Southeast Asia, this is commodity currencies as well, because they've had to keep interest rates slightly higher, have attracted huge amounts of money just to get some kind of return, and we've also seen a huge amount of money into this region, not just in Thailand, but just generally around Southeast Asia, and there is no doubt that's put a lot of pressure on currencies. And of course, you know, there are restrictions and controls to some extent, and manipulation and various things going on to try and keep currencies down as much as possible. If you think that things can carry on and Southeast Asia in particular can ride out whatever else is going on, then I suspect those currencies are quite good for the long term. But there are short-term dangers that if there is a sell-off and that hot money leaks out, drains out reasonably quickly, that there could be some fun and games, unfortunately, in the short term. I think the region is tremendous, taking a long-term view, and by that I do mean 5 to 10 years at least. But there could well be some serious volatility in the short term. But if you need any more thoughts than that, I'm sure Paul will be happy to give you his personal view on the Thai baht. Is that it then? Are we?
One question.
Well, I think if anybody wants to, they can.
I'm around, so I'm happy to carry on with my personal views and thoughts of life out there and why we're positioned and why we are. It's not there are lots of opposing views, I know, and they've all got just as much truth in them, I'm sure, as some of mine, but that's certainly how we're positioned at the moment. So.
Question about US farmland. For a non-farmer, is there a way that one can easily buy into a ETF holding US farmland?
Almost certainly. I don't know of one, but I'm sure there is, because US farmland, like quite a bit of farmland around the world, particularly US, has gone up in a not a straight line, but in a steady line. Been a lot of money to be made, mainly because institutions have poured money into it. It's the same with the bottoming out of the housing market. A lot of this is not housing demand as such from individuals. It's institutions buying up swathes of empty properties that are being sold out by the banks through mortgage busts. So you know, it's paints a slightly false picture, because institutions, this is where some of the asset bubbles are coming from. Money's finding its way into places it wouldn't otherwise naturally do, just to try and get a return on money. Because you know, there's so few ways to do it. You can't do that through cash type instruments anymore because of ZIRP, as they call it, ZIRP in America. That's closing out lots of other investment ideas. And I think I'm being asked to finish there, so thank you.
I'm being asked to ask you. I'm also being asked to put on my high heels and play the hostess job. Martin, look, we do really much appreciate you spending your time here with us again. And I certainly appreciate your wisdom and listening to what you have to say. And one of the things we'd like to do is to help you relax in your hotel room and
thank you.
Have a nice spot of white wine.
Thank you.
And thank you very much for.
Thank you.
Thank you. And if I could just remind everybody to just kindly fill in the little survey form that was put in front of you, because it does help us in the next event that we would run to make sure we are engaging you with the right kind of information that you need. Thank you.